we're going to get started. You guys are the chemists. I love it. Or interested in chemistry. So the panel is three of us. I will just briefly introduce myself. I'm going to give a little background to why this session is at a clean energy conference, and then we'll have a little discussion. So I'm Julie Zimmerman. I'm the Vice Provost for Planetary Solutions here at Yale, which is our climate and sustainability portfolio. So academics in terms of classroom and training on campus. We fund a lot of research and try to catalyze interdisciplinary collaborations. We also interface with operations and facilities. So if you were here yesterday and you saw Mike Richter, so all the geothermal work happening on campus and what Yale is doing itself. And then lots of external engagement around Climate Week in New York or the COP that's starting in any minute, as our office is kind of organizing the institutional front to that and the umbrella of how we show up at those things. I'm also on the faculty here in the engineering school and the environment school. I've been part of a few startups that have come out of our lab, and my area is really around green chemistry and green engineering, which is why we have this session today. I'm going to frame this a bit. So I just have a few slides. The first one starts with, what we use petroleum for, and everybody has been very focused on fuels, but if you notice, there's this thin line above that that says, actually, some of this goes into petrochemical products. If you look at it from the other side of the chemical industry of what is the feedstocks right now that's going in, it is, again, mostly fossil fuels that are feeding our chemical industry and the outputs around thermoplastics and solvents. So what is great is there's this effort to change the energy basis of the economy and the society, and what has been the primary focus of that, and lots of talk at this conference, has been efforts to electrify everything that we can and change the source of that electricity grid to be from more renewable feedstocks. So right now, more than a third of global electricity comes from low carbon sources, but that's the electricity grid, and most of the energy that is not electricity is still coming primarily from fossil fuels. OPEC, in fact, has a long-term global oil demand projection that it continues to increase, and every year they project even more and more growth in this industry. What's notable is what's happening is that red line. So as we electrify and we say, hey, we don't want your fossil fuel feedstocks for oil and gas and fuel, we are going to start climbing that value chain and making chemicals and plastics out of that. So we're still going to drill. We just can't sell it for fuel as much anymore. So we're going to convert that into higher value chemical products. What is the secret here is that if you look at a barrel of crude oil, 70% of that generates about $375 billion for the industry, and about 4% generates about the same amount, and that's going to chemical feedstocks. So the market is encouraging the petroleum industry to climb the value chain, switch from producing fuels, and in fact, we're writing policy as we electrify to encourage this transition. So then the question becomes, is this what net zero looks like? I have a solar panel or wind turbine powering my fossil fuel production and refining. I put carbon capture where I need it, and then I'm just producing a bunch of plastics and chemicals. So is this the goal? Is this what clean energy looks like, and that we still have a fossil fuel industry that's working really hard? And then, of course, we can talk about the nature of these plastics and chemicals that are going out in the environment and what they're doing to humans and ecosystems. So we really can't make this transition if we don't think about the makeup of the chemical fraction in addition to the electricity production. And this gets into some really uncomfortable questions about how does the petroleum industry continue to make money, and how do we use the market to push us towards safer, cleaner chemical production. So that's the framing for the panel. And the conversation and why we're talking about chemistry and chemicals at an energy conference. All right, so I'm going to bring you guys in. So we have two great panelists today. We have Drew, who's here from Connecticut Innovations, so from the investor perspective of funding new technologies, and particularly Drew has worked a lot with some chemical companies. And then Harrison, who is an alum of Yale from the School of Management here and Environment, who is the co-founder and chief operating officer for Oxalis Energy, even though you guys are a chemical company. So I'm going to ask you guys to maybe tell a little bit more about your story, why you're doing clean tech or green chemistry or engineering, and what is the thing that you're focused on right now at your company. So I'll start with you, and then we'll go to Drew.
Yeah, I appreciate the introduction here, and Oxalis does make more sense, but we do convert CO2 into both fuels and chemicals. So we have a technology that was basically invented here at Yale by our co-founder, who's right up there, Connor, in the chemistry department, that converts CO2 into a variety of like C1 products, both like carbon monoxide and methanol, that you can use in methanol as a fuel for shipping, aviation, chemicals, or carbon monoxide to also go to fuels or for refinery processes.
And why clean tech, and what are you guys focused on particularly at this moment?
Why clean tech? I'd say it's because it's a very, I think we're in a cool world transition. It's like not only just like climate change or global warming is the problem, and CO2 is the problem, but like on the other side there are solutions, and it really comes down to like more than climate tech, electro tech. It's like you're electrifying everything first. Like the bottom 80% is of emissions you can electrify, and then that top 20% of those hard to abate sectors, you can also find ways to substitute with electrical solutions like electrolyzers, and that's what we're doing, and that's how we've basically focused on what we're building.
Great.
Yeah. Hi, everybody. I'm Drew. I'm with Connecticut Innovations, the Climate Tech Fund. My background before joining CI was actually in project and infrastructure finance, working and investing in solar, wind, battery projects on the lending side. From that experience, just saw how much new technology we needed in order to hit our goals, similar to Julie's presentation, and had to think hard about, what's the right type of capital in order to achieve, my theory of change, which is that we need, a solution to 100% of our problems. And, that is venture capital, in my opinion. And it's patient and strategic venture capital, which is what CI looks to provide to the market. We help companies that are local, we help seed them, and then we help scale them.
So I'm going to pick up on that because I think that's particularly important for chemical companies or companies making fuels and chemicals. And that is, the funding model has to be really different. So first of kind plants, pipes in the ground, right? This isn't an app and you're going to get an ROI really quickly on just some labor costs. This is steel and pipes and land and permitting. Can you talk a little bit about how CI thinks about those investments in a different way to support these kinds of innovations?
Sure. Yeah. So just to situate everybody a little bit in the venture capital model, most venture capital funds are structured to return capital to their investors within a 10-year period. And oftentimes it's less than that, because if you're investing in year 3 of a 10-year fund, then you're already crammed down to a 5 to 7 year period by which the investors need to make their capital back. CI is an evergreen fund. We don't have any LPs. We fund ourselves off of our own returns, which does make us very financially motivated, but it doesn't mean that we are financially motivated in the same way as a private fund. So when we look at a company that might take them 10 to 12 years in order to generate a return for us, but that return could be so big because the market is so big, that is a risk-reward equation that we love. And it is a risk-reward equation that a lot of private investors do not love. So I think being realistic about the challenges and the requirements of taking on the industrial economy in its current form, I think demands a capital that is patient and flexible. And so we not only lean in to take home run type of swings in these types of sectors, but we size our checks commensurate with needing to reserve a lot of money for these companies. So most funds will invest 50 to 75% of the amount that they want to put into a company in the first check. We probably invest 10 to 20% of what we're going to eventually invest in the company in our first check by design, and knowing that there's going to be more funding rounds, there's going to need to be more capital later on in these companies as they deal with scale-up challenges. So, our fund model and our strategy is geared toward what we think is in the best interests of the companies that are working in these hard-to-abate sectors that are going to require, a lot of capital and a lot of patience.
So now he just put you on the spot saying you guys need a lot of capital and a lot of patience. Can you talk about what it takes to go from lab to market, the kind of capital you need, when those checks have to come, stopgate, those kinds of questions?
Yeah, that's a really good question. It does take a lot of time and a lot of patience to scale novel technologies, especially for the hard-to-abate sectors that Drew mentioned here. Basically, what you're doing when you're taking novel technologies and building a climate tech is you're taking something that's really interesting, a novel invention, a novel chemistry, novel physics, novel engineering, and making it incredibly boring. And so that's the goal of it. You go from like really cool venture capital to more like in catalytic capital to like infrastructure capital. And so you have to go through what's basically a tried and true plan these days, whereas you start first in the lab, and there are things called technology readiness levels that was invented by NASA, where it's like how much is this ready to actually be scaled up, and you start in the lab, and then you go to a pilot, and that's where your first funding rounds come in, like your seed, maybe your Series A. And a pilot's very small here, where you're producing your first stuff, then you go to a demo, then you go to what's like called a first of a kind, which is usually like a mini industrial facility. It's not a real industrial facility, but it's like it's the first time it's operating for a long time. And then you go to what's called an nth of a kind industrial facility, and this is where you basically removed all the risk there. So you're first removing scientific risk, then engineering risk, then manufacturing risk, and then partnership risk, and getting different capital along the way to finally it's an infrastructure asset that's incredibly boring, where all it is something that's on a 25 year Excel sheet, and someone can expect like a normal infrastructure return on investment. So you make something that's really cool, and it eventually becomes really boring, and that's the goal.
I imagine there are some challenges along the way, particularly for carbon conversion technologies. Can you talk a little bit about that? So you talked about maybe the generic path. What is specific or unique to carbon conversion?
Yeah. Glad to answer that, Julie. I'm not the smart chemist here, so I'll do the best I can here. But CO2 is pretty stable as a molecule, as you probably know here, and so it's hard to basically take apart carbon dioxide, because that carbon really likes that oxygen, and so you have to do what's called like climbing energy ladders, put a lot of energy in to break it apart, and so to do that you need to have a really efficient process that can do it and be able to scale it up, and so that's hard with a variety of different like carbon conversion or carbon sequestration technologies, is turning that CO2 into something useful or putting it away forever. And so you have to find something that can bit by bit and more efficiently use energy, because as you mentioned previously, you're electrifying things, and our technology needs electricity. You want to use that clean electricity as efficiently as possible.
So everybody talks about how much carbon dioxide there is, and it's such a big problem, and we have so much of it. I imagine sourcing CO2 at an industrial scale could also be a challenge for a company.
Yeah, it's true. It can be a challenge, but there's also a lot of CO2, and this is where also like policy and regulation come in. I think what's been positive about the last few years is, though there's been like a hit to climate change in the U.S., there's a better realization that like utilization is just as good or better than sequestration. Not every place in the world or the U.S. has a good geological facility that you can just put CO2 in the ground and turn into rock. Sometimes it just makes more sense to try to actually use that CO2.
And it's not just where the CO2 is. If you're in the electrochemistry space, it's like, where is the CO2 that's also close to where there is cheap electricity, which is also needs to be close to a CO2 pipeline, because most of the cost of the end product, it's not actually in the production, it's in the distribution and like the downstream like transportation of the product to a storage facility where it can then be used. So it's all of those logistics have to line up in order for a project, you know, to be competitive in the market. So it's not impossible. I mean, the traditional petrochemical industry like figured this out, and like as you can see, if you look at the map of where production is, it's concentrated in certain places for a reason. It's likely that like electrochemistry will take a similar path eventually, where a lot of these companies will have synergies with each other and will find nodes where, you know, we can build and scale up a lot of these plants.
Yeah, right. And the other feedstock, of course, is water, because or some source of hydrogen. So you started to allude to this, but maybe you could talk a little bit about policy, partnerships, incentives that are driving this and enabling these companies to go, because it's not just capital.
Yeah, I mean, I think on the policy side, it's obviously a very strange time that we're in, where like some of the incentives have gotten pulled back, and like there's also policy like from the energy market side, where, you know, we think about like the cost of electricity in Connecticut. You know, I know Constantine, partner on my fund, talked about this yesterday. Like, it's very expensive to produce electricity in certain places relative to others, right? There are some markets that are more heavily regulated than others. So, you know, even though like I think the federal policy is often in the news, I think when you're talking about electricity, a lot of times like state policy is potentially more of a driver. So understanding like which states have better incentives and better permitting processes and have done this before is equally important, even though like tax credits are a big part of the picture too. I'd also say, like, if you look globally right now, like just because the US is in a little bit of a moment, there's a lot of scale up going on in the Middle East, in Asia. The incentives in Europe are still strong. So yeah, I think, you know, we might be taking a step back in some ways, but I would say like on net, you know, there's a lot of like forward momentum. And I'd say particularly in alternative molecules, although there are challenges now with the macroeconomy that we find ourselves in and like downward pressure on price from new competitors and entrants into the market. So some of those dynamics are quite frankly like more impactful to the bottom lines of, you know, Oxalus Energy in other companies like it in a few years than whether you can claim an Inflation Reduction Act tax credit.
Yeah, I think I'd like to add to that it's just across the chemical industry that they're facing issues. They've taken a bit of a step back from interest in like alternative ways to produce green chemicals. But that'll come back, and the main reason for that is there's a lot of overproduction of your base chemicals that Julie put on the slide earlier. Most of this overproduction is being driven by like a Chinese overcapacity of your base chemicals, and then also the fact that as we do the net zero transition that you mentioned previously, some of these petrochem majors are starting to produce more of these base chemicals as well. And so they have the opportunity here where they can keep playing that game. And then as tons of clean energy starts being built up, especially in the Middle East and Saudi and the UAE, or in China, where you can immediately switch from like fossil petrochem to clean petrochem.
Yeah, it's definitely like we have investments in companies that are in these markets. Like Oxalus is going to get there, but we have companies that are a little bit later stage, and like they are feeling it on their P&L in terms of like margin pressures. And if you look at the corporates, they're feeling it too. If you go look at how BASF's like financial performance has been in the past couple of years, it's like they are explicitly, like you can see it in the stock price and some of the challenges, like some of those margin issues, because fundamentally we are still dealing with commodity markets, and with that comes a limited ability to sell on anything other than your price point.
Yeah.
And there's there's a little bit that you can do in high-end products, and Oxlos has done like a really good job, for example, of targeting like high-value fragrances and cosmetics and other markets like that, as has P2 Science, which is another portfolio company of ours. And that's part of the way through, is finding those areas where there is a customer that's willing to pay. Maybe that's like very rich people who are excited about SAF and want to fly on their private jet. And but there are ways through. It's just getting to that mass market, like selling at that commodity price point, requires a lot more.
Do you want to offer perspective from your company as opposed to kind of generalizations?
No, I mean it's all true. Like what Drew said here, it's like for these longer term petrochem majors that are long term partners of us, they're hurting. Like as Drew mentioned, BASF or a few of the others, like Covestro, which is the third largest German petrochem producer, is no longer German. They were bought out by ADNOC, Abu Dhabi National Oil Company, about a year ago, and so there's a lot of downward pressure on the petrochem majors here. But that's why you really do, as Drew mentioned, you focus on some of those niche specialty chem that are further upgrading the chemical sector while you're building your technology, so that way you can go from high price points, low volume, to hopefully large volume, low price point as you scale that technology from that lab all the way to industrial scale.
Great. I guess I'm also curious. We've talked a lot about the market and investment in capital, but there's lots of co-benefits with this. Can you talk a little bit about how an investor might think about climate benefits or other kinds of benefits besides just ROI?
Yeah, I mean, I think we think about emissions, of course, but we also think about environmental health in the communities, that are impacted by like the improvements in products. So sometimes we're replacing CO2, but I think thinking about like the environment in a broader picture is like really important when we consider investment opportunities, so that it's like real and tangible for people. Like I think like P2 is an example where P2 is replacing some products that are derived from fossil fuels, but they're also replacing silicones and like other products in the chemicals industry that are like not carbon derivatives, but they are just objectively like bad for consumers. And like their brand is very, is embraced by the market, not as a carbon alternative, but as a green chemistry alternative. And as a company, that is fundamentally redefining, the types of ingredients that we are using, in our beauty products, in our hair care products. So like we think about it much more holistically. I think that's the right way to think about it. Like climate change as a topic is obviously like our North Star. It's why I do what I do. It's why Harrison does what he does, I imagine. But, when you're thinking about like climate change for, people who consume products can sometimes feel a little bit amorphous. So, making it real and connected to like their lived experiences, like equally, if not more important.
I love that our investor in P2 can tell our marketing story, so I think we're doing a good job. Okay, I'm going to ask one more question, and then we'll open it up to you guys. And this is a bit of a, if you could talk to either a federal policymaker or a state policymaker, as we're a Connecticut thinking group, what is like one policy change that you feel could come at the state or the federal level that would unlock the potential within reason, right? Like not unicorn peers and, but like what's something that's tangible, that's near term, that you feel like could just unlock a lot of potential if we had a change at the policy level?
I mean, like my policy recommendation would be like a lot of direct investment from the government's perspective. I mean, we're seeing like the current administration doing this in the form of just randomly taking equity stakes, but I think what we really need is early stage, high conviction, revolutionary, financial investments, non-dilutive into transformational businesses. Then not from a return on investment perspective, but if you look at how we built the internet and how we built a lot of the foundational technologies, like a lot of them had a national security lens, and a lot of it came out of DARPA and like defense-driven like mandates. I think when we think about like energy security and we think about, the next 100 years, there is a really good case to make that money into these companies like has a massive, maybe not near-term quantifiable investment return, and it takes the pressure off of VC. Like VC is like obviously it's really awesome to be able to invest in early stage companies, but it is incredibly hard for venture capitalists to make money in a space like sustainable fuels or chemicals in the time period. Like CI is a very unique fund, right? Like we will not be the norm. We will never be the norm. Like this is a private market for early stage investment, and like if this is actually going to scale, like we need to assume that like venture capital has to make a financial return, which means that we need a lot of upfront support and catalytic non-dilutive funding into strategic industries.
Well, I think you teed me up there. I completely agree with everything there. I'd say here, like the two things I would say is number one, I completely agree on the state support and like federal support in early stage ventures. Like what we can see right now with this energy transition fundamentally is that it's driven by China. Most of that electrotech and electrification is driven by China. Like they already have about 40% renewables load build out there. Everything that enables that electrification of the bottom 80% of emissions basically comes from China. You do all your mining, your critical mineral processing outside China, but owned by Chinese firms or in China. Then you have semiconductor manufacturing. You have transistor manufacturing. You have batteries. And what do you call batteries on wheels? Oh, that's an EV. What do you call batteries with a helicopter? Okay, that's a drone. So you have all of this national security, EVs, batteries, and that being built in China. And the way it was allowed to be done was, number one, we outsourced all our manufacturing to China, but that's a separate issue. Number two is there's tons of state support at the local level between various Chinese municipalities at these small companies where they basically have their own version of like Chinese capitalism where they fight themselves to death and a huge one emerges like BYD. And that's how BYD is able to take over the world EV market right now, especially in Latin America. So you need state support for these emerging technologies because fundamentally the electro stack is the future of national security with drones, with EVs, with automation, with electrolyzers. And then you need to be able to make sure it can actually be supported there. So not only is it small support at local companies at probably the state level, but you also need to do what we did with the COVID-19 vaccine, or how we discovered the Human Genome Project. That was funded by the state and competitive, I don't remember how it worked, but competitive private companies also did it at the same time. And so they were competing with each other, and then it got done. So you need both long-term planning from the highest level of the state as well as state support underneath, because these are the technologies of the future for not only climate change, but also for national security.
Yeah, so it's both infrastructure and public good, right?
Yeah,
so that makes a state case. Okay, I'm going to turn it over to you guys. Hopefully you have had time to come up with some questions out there. Yeah.
So one thing you talked about is like the commoditization of base petrochemicals now, right? And then, but you suggested, right, so the energy mix is getting more and more renewables based. So petrochemical, like these big oil majors are going to point to continuing to produce these commoditized fuels. I guess if that suggests that price deflation is going to continue to exist in this market, but then you have how are alternative fuels, such as what Oxalus is doing, going to pass these in terms of the market dynamics? Is it that eventually you think that basically alternative fuels are going to get cheaper than these petrochemicals, or is there another reason that you think these will stop being as commoditized? I guess how are that cost or those price curves going to pass each other and like make it so that we use alternative fuels more?
Well, I think it honestly comes down to just one country, and it's just Saudi. Like, I mean, at the end of the day, like, they are the leader for OPEC, and they determine price fluctuations in oil and gas. But you can also build solar there for less than a penny per kilowatt hour. So if you're in the energy transition here, you can play both sides perfectly. Like, I mean, you just have tons of cheap renewable solar panels getting cheaper and cheaper coming out of China. You're building them out in Saudi and the UAE. You keep pumping oil for petrochem. And then once it's basically time to switch to some petrochem not going to plastics, you just do it with green hydrogen from electrolyzers.
I would say I think part of it is the secular trend on solar and battery prices continuing to come down. Like, I think fundamentally the bet is that like the inputs like of electricity like will become cheaper than your inputs for petrochemical production, right? Like, and I think there's good reason to believe that to be true. Like, independent of like short-term like data center and industrial manufacturing demand, I think the long-term trend is highly clear that like the price of lithium-ion batteries like has continued to come down. Like, I think there's a lot more lithium that people thought, which will continue to drive that price down. And independent of like short-term tariffs on solar, like the amount of efficiency gains and capacity improvements that we're getting out of solar like creates the models, thereby we're able to produce like e-fuels and e-chemicals like at a price point that's competitive.
I think the other answer to your question is just like the petrochemical companies are climbing the value chain, maybe stopping at methanol or fuel rather than climbing up the value chain with renewable or CO2-based chemicals also, so that you can kind of ride that and wait for the market to sort out the fuel prices, but you're selling lower volume, higher value products for the time being. And that's what P2 Science has been focused on.
Yeah.
Thank you.
Yeah.
Great panel. Harrison, I saw that you all raised capital last year, and I'm curious with what you know this year, how you would think about strategy, if you could know how 2025 was going to play out, if you would change anything from capital planning, how you're commercializing what you're doing. Maybe some money more quarterbacking, but curious your take.
Yeah, that's a great question. I think, as like Drew mentioned, with like the importance of like patient capital, and that is also like being like patient from an operating standpoint. It's good to have very low burn, not higher only as much as necessary, to basically, it takes a lot of time to get something out of the lab. It takes a lot of time to pilot something. It takes a lot of time to demo something. And trying to go to market too quickly can be very bad. You can lose a lot of goodwill with customers. You can waste a lot of money. And so I would say it's better to not overpromise and be incredibly deliberate about what you're trying to build and how long it's going to take, than going out too early.
Yeah, I'll just add to that. I think there's been a lot of companies in this space that have raised a lot of money a few years ago. Like, in part of the lack of discipline is in part like derived from that, where people overbuild. They build before they solve for unit economics and manufacturing efficiency, right? And like plant efficiencies. And the answer, it should be like the complete opposite, where you're solving for plant efficiencies as you're building your tech stack, and like then you're spending money to validate that / make changes where you need to. But like a lot of these companies that have raised $1 billion, like they took in the money before they had solved for those issues. And like, so I do think there is a benefit to the world that we live in now, where we have capital that's a little tougher to come by, but for the companies that do that work and have shown that, you know, they have solved for those unit economics, they're going to outperform the ones that raised a lot of money too early, like every day of the week. And like they're going to be healthier businesses from a capital structure perspective because they didn't raise an insane amount of money at high valuations. Like, I think valuation discipline in this space is really important. Like, you might raise around maybe it's a slightly lower valuation, but that's just a macro dynamic. Like that'll like correct for itself in the next round or the round after that. Naturally, it's better to like raise from the right partners. So like Oxalis raised, CI is part of that solution, right? We participated in that round, but they also raised from Toyota, which is a corporate investor. Like they don't have like a need to get their money back in 5 years. They raised from a fund called Azola Ventures, which is a 15-year fund. It's catalytic capital. They're intentionally investing in companies that they know will take time potentially. So like all of us went in together with a similar philosophy and a conviction in what we knew needed to happen, and also like that we were like backing the team that we thought could do it.
I think the other interesting thing here is that another company that also spun out of Yale called Air Company, which is also a CO2 to sustainable aviation fuel company. Their biggest investor and client right now is Department of Defense. And it's not about climate benefits. It's that if I can make fuel out of CO2 and water and sunlight, I don't need a supply line to get fuel to the front. And so they're willing to pay more per gallon. And so it's also what story you're telling, how you're positioning this. Is it a climate tech or are you solving a different problem and it happens to be a climate tech? Mm-hmm. And that unlocks different capital. Yeah, please.
Do you want to go first?
You guys duke it out. I don't. Yeah.
I guess a question maybe for Harrison about fundraising related to maybe a problem I have. As Julie pointed out, you need to buy a whole lot of CO2 and probably sell a whole lot of methanol and CO for your business to make sense. How firm do your supply chain agreements have to be, and your offtake agreements have to be from a fundraising perspective, kind of as you go through the?
Yeah, that's a really good question. So there's this venture capital firm called Extantia. And they have this cool thing that like we've showed our employees, and it's called Maslow's hierarchy of offtake. And it's like basically a pyramid here. And basically, like the goal once again is to make it boring. And so a boring offtake agreement is a credit-worthy offtake agreement where you have a partner that hopefully has a really good credit that like signs long-term offtake because it's like hopefully it's a 25-year asset. You have a 25-year offtake. You can take it to the bank. It's signed. They're like, oh, that's great. Now we can do some debt financing. This is so boring. I love it. But that's the pinnacle there. But before that, you have to climb this pyramid here. And the first is like when you're like at the lab and you don't have product, you should probably be focused on long-term customer contacts, like showing that there's interest there and developing that relationship, because it's going to take 10 years, 7-10 years to get that contracted offtake. And so not lying or over-promising to your customers is a huge thing. So you start with customer engagement, talking to customers, where you're going to be. Then you get LOIs or letters of intent and interest for some of that offtake, and then MOUs once you're getting closer to that pilot. But you need to have a product first, and then which are like memorandums of understanding about actual, like they're interested in taking some of the product there, and then then after that you have some with price and volume considerations where it's like, oh, we're interested in potentially buying this much offtake at this price point. And then there's like what's called like a take and pay contract. And so you're firming up as you go up this pyramid how like credit worthy, how real this offtake is. I hope that answered your question. I bet Drew, you have a
I kind of nudged you, and I think he did too. Can you talk about the CO2 feedstock side, right? We don't have a carbon dioxide pipeline in Connecticut, as far as I know.
Nope.
Direct air capture is still thermodynamically questionable with today's materials and energy. And so, where are you getting scale for your CO2 feedstock reliably?
Yeah, that's an incredibly good question, and I think that's why we've been really focused on CO2 sourcing as a company, because you need CO2 because it's your feedstock, just like you need electricity, but also your partners care about the type of CO2. Some stuff, especially when you're going to a high-end value chain, it's like if I'm gonna sell a methanol-derived cosmetic, like the person who's using that cosmetic probably doesn't want to know that that CO2 came from coal. Are you going to really spray coal all over your face? No, you're not. So like you have to actually find like different types of CO2. Look for biogenic, what's called biogenic, or from like an ethanol CO2. And so that is also that pyramid there. It's like the first thing is talking to these partners, where it's like, okay, there's an ethanol facility in Decatur, Iowa, for example, and they produce like hundreds of thousands of kilograms per day of CO2. Like at the lab scale or the pilot scale, we're too small for that, and so we need to be realistic and walk them along the journey, but not overpromise of where we're at, so that way 5-6 years down the line we have that offtake of CO2, which is one part of the equation, and you also feed that back into the model of making it boring, and then you have the offtake of the other part of the equation to make it boring. So yeah, I hope that answered the question there.
So, great panel, first of all. Thank you so much for doing this. The question I had is, you spoke about TRL and moving from TRL 1 to 9, right? And you spoke about some of those risks which exist along the way, partnership risks and infrastructure risks, and I know you mentioned a few others. What do entities like Oxalis see see themselves doing to reduce some of these risks? And then how do investors who are investing in a lot of these technologies within the same space, in this case alternate molecules, what can investors do to help entities such as Oxalis de-risk their value chain across that? It's completely de-risked and there's more money flowing in. We can hit those economies of scale quicker.
Yeah. Well, I think you need to go you need to go in a logical way. So the first is like if you have all these different risks, there's scientific risks, engineering risks, scale up risk, manufacturing, offtake risks. You have to start at the beginning, which is you have to de-risk the science, and then the engineering, and then the scale up, then the manufacturing, then the supply chain, and then the offtake there. So it has to go through just the steps.
Yeah, we help in different ways. So in that early tech and science risk stage, we have a program called Entrepreneurs in Residence, where we take people, senior executives from corporates in the state or in the region that are looking for ways to help early stage companies, and free of cost to the startup, we'll plug them in to our companies that they could potentially join full time, but they could also be advisors who have had to figure out how to get an electrolyzer performing at 10,000 hours, for example, and they understand what that entails. At the scale-up side, we do a lot of work helping our companies with procurement and piloting. So we have a program called Innovation Lab, which will fund up to $50,000, sometimes more dollars, for a corporate to work with a technology company to purchase their product, sample the product, make sure it works. Because a lot of the times, these are very old legacy industries that they don't want to pay for anything right away. Right? So what we try and do is we intervene and we say, look, we'll pay for it to start if we outline some of these KPIs between you and the company, such that if they actually prove those milestones, you're going to be willing to commit to something. And that helps us get market data as well, in terms of actually pushing these corporates or these offtakes to say what needs to be true in order for them to actually make that purchasing decision. And then that gives us a sense working backward as to how much money this will take, what types of de-risking we still need to do. So we have different programs. It's pretty unique as part of the state fund, but they've worked really well. We've worked with Oxalis and helping them with advisors on that early stage side. So.
And then you didn't ask, but I'll tell you what Yale is doing. So I think the other bit there is really early on bringing industry in to say, what is our problem? So that pitch yesterday of these are the needs, so that researchers are already orienting their work in the lab towards a solution. There's always a role for curiosity-driven research at a university, but for those who are interested and willing to open that dialogue with industry really early on, to understand needs, so that TRL1 is already on a path towards someone who cares about what solution you develop. Yeah, please.
somebody had to ask a question about AI. I'm curious to hear how does the growth of AI and investment into AI is impacting climate tech fundraising generally, in the sense that investors might be more motivated to go with software-based solutions which have a shorter turnaround time versus harder climate tech. With its ecosystem needs, you need a lot of players to make the whole thing work and come down cheaper. You have a longer investment recovery time, and obviously like a lot harder technology with electrotech. So is this a zero-sum game, or are these completely different investor groups? What are you saying?
No, they're not completely different investor groups. There's some overlap. I mean, I think part of climate tech and what drove a lot of money into climate tech a few years ago was, well, it was a belief in climate change, but it was also this, like, we're going to go chase shiny objects and like these big problems, right? And so like those types of funds who raised on those premises are quickly now moving into nuclear, AI, critical minerals, right? Like whatever is quote unquote like hot. And that affects industries that, you know, are not in that natural category in terms of like how much money is available and what different funds are working on from a thesis perspective, what types of conferences they go to, what profile companies they're sourcing. I don't think it's impacting as much like whether investors want to invest more in software. Like I think there's still, I think if anything, AI, in my opinion, and a lot of investors that I talk to share this opinion, it makes hardware and physical assets like much more technically defensible. Like when we think about like moats in intellectual property, like AI makes software investing less defensible a lot of the time because it's easier to replace. Like there's going to be a new AI intervention that like might make whatever software was developed a couple years ago like less special very quickly. But you can't automate like building physical infrastructure. Like you can automate the discovery process. You can like get a lot of knowledge about like, oh, what catalysts perform better under which conditions. Like there are some things that you can do to speed up that process, but the actual building of the thing is like not some, like there's a time-based competitive advantage for the companies that have figured out and de-risked some of the construction and like the technology scale up that can't be replicated.
Thank you.
Yeah.
Going back to using China, competing with China as a, call it a proxy for developing more localized abilities and capacities and skills in the clean tech world, where does it just knee-jerk, where are some opportunities for progress and growth and, I hate to say energy independence, but at least being able to move forward, whether it across the development chain, whether it's feedstock management or market manipulation or chemical conversions or EV battery manufacturing or lots of other things that you guys have mentioned that I can't think of right now. Across the entire spectrum of, let's put it under the umbrella of electrification, the 80%, where do you see more kind of near and intermediate term opportunities, given enough time and money, we could all do everything, but since resources are limited, and in particular in the context of probably not having as much government non-dilutive support in the immediate future as we had previously.
You want to go first?
Did I cover enough?
No, I did think about it.
I mean,
Okay, Julie, go ahead.
I'll start so you guys can think. I think the place we've seen is sustainable aviation fuel because you can't electrify long distance flight right now. And so because of EU, because of policy, because of regulation, and some airlines have made public commitments, that is a place where we have seen opportunity. So it's a hard to electrify sector, maybe impossible. You have policy or a floor that's underpinning it coming out of the EU, and you have public commitments from brands that care about reputational risk. And so that's been a place where we've seen growth and opportunity. Is that enough time?
Yeah. Okay. I think I have some ideas here, but I don't know how good they are.
Probably better than the question.
No, it's a really good question. So I would say, like, like because China owns so much of it right now, whether it's battery manufacturing or solars, you need to go to the next horizon. And so I think there are opportunities there in like next gen solar, next gen batteries. Like lithium ion, as Drew said, is going to continue to get much cheaper, and the value chains and supply chains are already in China. But there are new battery technologies and chemistries that are coming out. There are new photovoltaics here. And then we also have a fundamentally great consumer market. There are ways where even though the batteries are being built there, like you can just do different consumer applications here. We used to talk about like IoT, like the Internet of Things. But realistically, as you build out renewables everywhere, you have like the IOB, the Internet of Batteries. Like you're going to have batteries in everything. You're going to have it in a lot of larger end consumer devices like a fridge and that. You have battery packs. You have like the Tesla Powerwall. There's going to be opportunities for small batteries and basically your shovel and picks theory of innovation here. And then also other next gen technologies like electrolyzers. Like eventually electrochemistry will eat thermochemistry. So like you heard like in I guess like the early days of the internet, like Mark Andreessen said, like software eats the world. Electrochemistry will eat thermochemistry given enough time and given enough electrification there. It's just going to take a lot of invention and a lot of capital to do so. That's what I was saying.
I agree with all that. I think the only thing I'd add is like when China was way behind, like they invested in their own industrial base, but they also worked with people who knew more. Like I think it's a very controversial topic, but one that I think we need to acknowledge is that like in many cases, like we need to be doing joint ventures with some Chinese companies that are well ahead of us and like reshoring some of that production. Like we're doing it with batteries, with Hyundai and like companies that have Japanese companies that are like have gotten way far ahead of us on hydrogen and ammonia and other aspects. Like I think that is very much, we need to like acknowledge that and also learn from what others have been doing, while we've been on the sidelines.
Yeah, I think I remember hearing that Germany is learning some manufacturing techniques from China, God forbid. You talk about a holy grail for a nation. If they can do that, then what you said.
Yeah.
All right, one last question maybe from the audience, and then we'll wrap up. Are there any more? Yeah, please.
Gilad Dekel for Clean Hydrogen. I was wondering with all the upcoming renewable energy advancements and maybe thorium nuclear plants right around the corner, 5-10 years maybe. Do you think a lot of petroleum industries will follow maybe Ørsted footprints and completely go into renewables, or did they have something special for them that made it possible?
Sorry, I don't think I heard. So will oil companies like
shift their business process into maybe renewable?
Yeah, I think probably not as much as we thought a few years ago. And I think you can see this in like the public comments in Equinor's latest shareholders meeting. You can see it in the comments of Ørsted's shareholder meeting that is very public at this point. Like I think the strategy that some of these companies take, at least the one that I would be taking, is maximal diversification. Like there's just so much risk geopolitically, macro dynamics, that like I think they're going to try and just do all of the above in a way that like if we had a government that like was trying to hedge that risk too, like it's what makes sense in a time of significant uncertainty. I don't think they're going to retreat all the way back so much as like they're not going to want to be so exposed that they wake up one day and like their stock price goes down by 50%.
Yeah, I'd agree with Drew here. I think they're also just fundamentally different business models. Like petrochem and oil is fundamentally like an OpEx business model where you stick a pipe in the ground and out comes like the I drink your milkshake thing. But versus like renewables and electrification is a CapEx model. And so either you're a developer and you basically import all the solar panels from China, or you actually have to have the manufacturing capabilities, aka China, to make this stuff. And so they're different business models, and it's hard to reconcile something that's fundamentally OPEX with something that's fundamentally CAPEX at the end of the day.
All right. I'm going to ask you guys in a minute, what's one thing that you want people to walk out of here with in their mind as a takeaway? And I'm going to do mine first so you have a minute. And I'm going to go back to where I started, and that is, this is a clean energy conference. We're really focused on this transition. There's so much emphasis on electrifying everything we can. And is it a potential unintended consequence of driving the petroleum industry to just make chemicals and plastics out of this product now that we're seeing we're not going to use in the traditional applications? And so these things are really coupled, and if we really want a sustainable future, it's not the net zero future that I put up in the beginning.
I mean, I would just say I think it's in a time of retrenchment and like economic uncertainty. It's very easy to just get incremental when you're thinking about like what needs to happen in order for us to, achieve our goals. Like, I think this is where like home runs are out there and are exciting to bet on, and like there is a lot of investors or partners who are afraid of investing in the most disruptive technology, but like I think we should not lose that ambition and aspiration, just given everything that's going on and energy demand and electrification, all these things, data centers. Like, it's easy to just like start solving for like temporary band-aids versus what we really need, which is moonshots, and we will continue to need moonshots given the trajectory of oil demand that you were pointing out. So
yeah, I agree with both. It's an exciting time. Like, I mean, we're electrifying a lot of the world, and there are unintended consequences, and that means we have to be careful about what we're doing. But it's also all these technologies of the whole electro stack, whether it's semiconductors, electrolyzers, batteries, photovoltaics. That's the prize of this century. It's going to not only determine the energy transition, but geopolitical power as well.
All right. Please join me in thanking our panel.